Good morning and welcome to the Business Standard Morning Show. I'm Nazia Iqbal and here's a look at the stories for the day. Google and Facebook's position in India's digital ad market broadly places them at the same level. But Google has mostly avoided controversies that have plagued its smaller rival Facebook in India, which is also the largest market by number of users for both. What is the reason for Google enjoying a gentler political environment despite its size? Let's take a look.
The Indian subsidiaries of two of the largest digital ad behemoths, Google and Meta platforms, have reported their results for the last fiscal. Meta's Indian unit, Facebook India Online Services, saw its gross advertising revenue grow 41% to 9,321 crore rupees as the pandemic boosted the growth for digital ad platforms. Digital marketing has become a centerpiece in the growth strategy of corporations. In comparison, Google India's gross advertising revenue soared 21% to almost 13,900 crore rupees, cementing its dominance. Together, the two platforms control more than 70% of India's digital advertising market. One can agree that Google has become increasingly critical to our lives, more than Facebook. 98% of Indian smartphones are powered by Android, and Google's search engine needs no introduction. Companies rely heavily on its non-advertising services, such as the Google Workspace that provides a host of collaboration and productivity tools, as well as its cloud services. While Google's tools are seen as critical internet infrastructure, Facebook mostly provides a platform to air our views. While Facebook has been a favorite whipping boy, Google remained under the radar despite being a platform for several objectionable content, including the dark web. Facebook invited a lot of political scrutiny over its activities. More recently, when a whistleblower alleged that Facebook struggled to police hate content in India, the Parliamentary Panel on Communications and IT, headed by MP Shashi Tharoor, questioned company officials over it. Google too has a larger Indian workforce than Facebook. This begs the question, if Google is being seen as so systemically important, then why is it flying under the radar of politicians despite its significant presence in content, mainly through YouTube? Last year, an article by the Wall Street Journal triggered a political storm and raised questions about Facebook's content regulation practices in India. The paper reported that the social network company favored one political party. The Google-owned platform hosts a ton of problematic content, including fake news and misinformation. However, it has not drawn as much attention as Facebook. But the same yardstick has not been applied to YouTube, which is by far the largest streaming platform in India. The main Facebook app has 350 million users in India, which is less than YouTube's 450 million. Starting January, YouTube is updating its terms of service, which now requires publishers of news and current affairs content to furnish the details of their accounts to the Ministry of Information and Broadcasting. The requirement is part of new intermediary guidelines notified in February this year.
Google, on the other hand, has a slightly, they don't have anything in terms of a social network, so to speak. Scope for two-way interaction is lesser in the products and platforms that Google has. On the issue of running into political issues more in India compared to others, it's kind of natural. If you look at even what happened with Twitter, so a lot of politicians, a lot of public figures, a lot of everyone who's anyone is going to be on one of these platforms, and Facebook, Instagram, and even WhatsApp drive a lot of reach for a lot of politicians. There was, it was because of a reason that WhatsApp became such a huge issue before the previous Indian elections. And that kind of lends Facebook to a more sort of scrutiny from these figures. Unfortunately, probably for Facebook, they've also been through a series of whistleblower allegations, people who've come out and said that the company hasn't done enough to curb hate speech. They don't take elections seriously, etc. And globally, if you look at what has been happening at Google, there have been issues at Google also. There have been whistleblowers from Google who have complained about the way things work. There have been issues around Black Lives Matter. There have been issues around equality amongst employees, etc. But again, because the nature of the business is such, the basic nature of the businesses is very different.
A major action that Google has faced is a 2-year investigation by the Competition Commission of India over its alleged abuse of dominance in the Android smartphone market. The probe reportedly found that Google used its financial muscle to hurt its competitors. CCI's report said Google reduced device manufacturers' ability to opt for alternate versions of its mobile operating system and forced them to pre-install Google apps. Even amid such serious allegations, Google has not faced the wrath of our politicians. Perhaps it is time for our elected officials to give closer scrutiny to the internet giant.
Away from the controversies surrounding Facebook, a set of new age cards is slowly making its way to people's wallets. Issued by millennial-focused fintech companies, these cards are promising better deals than credit cards. Even as banks are still adopting a conservative approach to issuing credit cards, these new pay later cards are being handed over to people who don't even have a credit history, like students and blue-collared workers. Let us find out why these pay later cards are catching up and what is drawing people towards them. On its website, Slice introduces itself as India's best credit card challenger, and it is apparently emerging as one. Slice turned as a unicorn after raising $220 million last month in a Series B round. It is issuing 2 lakh cards every month, trailing only HDFC Bank and ICICI Bank, and boasts a waiting list of over 1 million users. And just like Slice, another startup, Uni, is also making its mark and has found a disruptive workaround in the form of pay later cards. In October 2020, Uni raised $18.5 million in a seed round without a product in hand. Today, it is adding 1,000 new customers each day, with disbursals hitting 120 crore rupees for the month of November. The startup claims it is seeing a 40% month-on-month growth. Let us find out how pay later cards are different from credit cards. India has just 66 million credit cards in circulation. On the other hand, 934 million debit cards were in circulation in October. It is because it is not an easy task to secure a credit card in India, as banks are highly conservative in this segment. They prefer customers with full-time salaried jobs or those with high credit scores. If you are a student, freelance professional, a self-employed person, or a blue-collar worker, you can be rest assured that banks would largely ignore you. But the fintech companies offering pay later cards are promising to change this all. More than anything, by focusing on millennials who are digitally active but without a credit history, these startups are helping them build credit scores for the first time. For this, Slice is issuing cards with a credit limit as low as 2,000 rupees, which is then dynamically increased as users spend more and get consistent in repayment. Uni's CEO and co-founder Nitin Gupta told Business Standard that its existing card is designed for people to tide over short-term liquidity issues. While Uni currently depends on credit scores to choose its customers, the startup will soon launch another product that is targeted towards customer segments that do not have access to credit today. And unlike the credit cards, pay later cards don't have revolving interest. Credit cards charge interest on interest, and in case of late payment, interest is charged from the date of transaction. In pay later, there is no interest fee on new purchases in case of partial payment. Uni CEO Nitin Gupta, who was previously the founder of PayU India and CEO of Ola Financial Services, tells us about it in detail.
What happens in a pay later, right? Every transaction is actually a loan. Credit card, what you have is something called as revolving interest. What that means is that let's say you get late in paying, then from the date of transaction, they can apply interest charges. Or let's say you did not pay your full due. Right? Let's say your bill was 10,000 rupees, you paid 2,000 rupees. Then the remaining 8,000 rupees interest will be capitalized from that day. But let's say you did another transaction of 3,000 rupees. On the new transaction, 3,000 rupees, interest will be happening from day one itself. There will be no interest free period. Now, in case of a pay later, because every transaction is a loan, that doesn't happen. Let's say you get late in paying, then only late fee can be applied. Retrospective interest cannot be applied. Now, let's say you had to pay 10,000 rupees as your due. You paid 2,000. So you are paying higher interest on the remaining 8,000. Now you did another 3,000 rupee transaction. That another 3,000 rupee transaction is a fresh loan governed by the terms and conditions originally signed. So on that 3,000 rupees, there will be no interest charged. Right? So that's the first meaningful difference, no revolving interest. Second meaningful difference is that there is no interest capitalization. In credit card, every month, the interest that was charged will be capitalized, and then interest on interest can be charged. In case of a loan, interest on interest or interest on fees or fees on fees can never be charged. The third fundamental difference is repayment schedule. Credit card has no repayment schedule, right? You can actually carry a credit card balance forever. You pay minimum, then you skip, you pay minimum, you skip. In case of a loan, right, there is an end date. It's a term loan. We are giving a 3-month loan or a 24-month loan, right? There's an end date, there's a repayment schedule. Credit card doesn't have a repayment schedule. And pay later cards, the way they work is that they give you a pay later line and they then give you a zero balance prepaid card. Now, what happens is when a customer uses this prepaid card, let's say you're using 3,000 rupee transaction in Shopper Stop, right? Then 3,000 rupees from the pay later line is in real time disbursed into the prepaid card. And the prepaid card then makes the transaction for rupees 3,000. It happens in real time. Pay laters run on top of prepaid cards. Credit cards are credit cards.
A pay later card offers greater flexibility and simplicity in repayment also, which is what the companies are projecting as their selling proposition. Slice and Uni both allow their customers to split their bills equally over 3 months with no additional charges. This business too comes with its fair share of risks in the form of non-performing assets, and the true test of their underwriting process will be known only in the medium term. But in due course, we can expect such innovative lending companies to substantially increase the total addressable market for their cards and other credit products from traditional financial institutions. Unlike the credit card segment, the present situation in markets is not that upbeat. The Sensex and the Nifty 50 indices last week ended below the 58,000 and 17,200 levels respectively amid the Omicron threat. Now, all eyes will be on the Reserve Bank of India's bi-monthly monetary policy meeting this week. Globally, investors will track information about the coronavirus variant to estimate the future course for markets. Talking of future, Business Standard's Puneet Wadhwa spoke to Bhaskar Lakshmi Narayan, Chief Investment Officer and Head of Investment Management for Asia Pacific at Julius Baer, to understand how the new variant might change the outlook for equity markets in India and elsewhere.
Hello, Bhaskar, and welcome to the show. Let me start by asking you, the way markets have reacted to the new COVID strain. it seems that they know more than the medical experts do right now. So what's your take on this?
That's a very nice way of putting it, Puneet. But let's put it this way, and I think that's at least from a market sense and from the way that we look at the investment world, I think we're very clear that the risk from COVID is not going away. Now, I don't want to specifically comment on one variant versus the other, but I think the way to look at it is when you're building in any scenario from a portfolio construction point of view, from a risk budget point of view, I think you have to take into account that COVID in one form or the other is going to keep bouncing back like a bad penny in the construct.
Okay. How do you see 2022 shaping up for equities then as an asset class?
I mean, I think that this decade, the coming decade, belongs to equities. There is, I think, very little doubt on this. Okay. So across the world, I think equities will end up being the winners of the 2020s as against any other, as against at least the fixed income universe. I'm not saying that there's no opportunity in the fixed income universe, but I think as a broad asset class, I would choose equities over fixed income. Now, in that space, there are a couple of large, still aggressive growers, I would say, or new growers, and these happen to stem from a few places. And they traditionally, or at least in the last few years, have been US, China, India, are the main hotspots, okay? Where either you're getting new companies or the growth is just structurally stronger than other places. And I think that's why India is a long-term story, I think still has a lot of legs. Now, we can talk about valuations in India. They're always going to look aggressive and rich. They've always looked aggressive and rich. So as we always say, valuations is a resultant. That's not what you make all your decisions on. But I think India Inc. in that sense still has legs from any long-term kind of potential that you can think of. But I would still be voting. If you want to ask me from a global investor's point of view, the big bet still is the US. It's the developed markets. It's the US leading that way.
So how does the FI picture look? How are they viewing India as an investment destination within the Asian and the emerging market universe?
Well, first, let me start with the global so that you get the global picture.
Sure.
India is still the marginal allocation. It's not, it doesn't take center stage for multiple reasons. There are access issues, and you also have it as still as a small, from a weighting point of view. Even today, even in MSCI Asia Japan, it's about 13% now of the index weight. So it's not dramatic when you look at it from a world complex, right? Because you still have whatever 51, 52% of the world market being in the US. So I think that's why the predominant bet has always been China as the larger market. But given what we've seen there, maybe that's one opportunity set. But given the flows again this year, that doesn't seem to have happened, right? It's not like people sold out of China and bought India. For me, really, what really sinks to me in India is the SIP. The fact that the locals are participating in this for the first time, I think, in a long time, systematically in the bull run.
So what's your sense on corporate earnings for the next few quarters in the Indian context?
Okay. Well, I think one is the Indian context, but I'll also give you the global context on this, because we're going to have 2021 to be a big base year effect when it comes to 22. So almost nothing is going to look as exciting as it did in 2021. Okay. This year, by the way, will go down in history as the biggest beat year across the world. I mean, it doesn't matter where you are, right? And I think this will almost never be repeated for a very, very long period of time. So we have to take that into account. In a way, we always say that the market's smarter than all of us. So I'm assuming the market knows this. If we know it, the market knows it. So I'm assuming that's where it will be. But I don't think it'll be a negative earnings growth, if that's what you're asking.
Okay. So in this backdrop, what should be the ideal portfolio construct for investors to tackle opportunities and risks that lie ahead in 2022?
Look, I think for the middle of the line investor, I think somewhere between 52 to 55 is where you need to be on equities. You are somewhere between somewhere around 35 in bonds, maybe about 10 or so in alternate assets, and a little bit of cash is typically where you should be at this point in time. So give or take a few percentage points here or there. So again, like I said, the bet is really for the average risk profile. I think the equity space is the best place to be. And I think this applies everywhere, including India. So
thanks, Bhaskar, for joining us today. We hope to see you soon again.
thank you. Thanks, man.
We will wait and see how markets behave in days to come. Meanwhile, as the pandemic still looms large, your savings will come in handy in rough weather. And what is the easiest way to keep your money safe? The answer would be to put your money in a bank account. India has different types of bank accounts for different purposes. Let's talk about the various types of bank accounts we have in India to help you decide which one suits your requirements best. There are 4 types of banks in India: private banks, public sector banks or nationalized banks, foreign banks, and cooperative banks. You can open an account in any or all of these banks. Let's start with the first type, the savings bank account. Well, as the name suggests, these deposit accounts are for consumers to save money. So, any India resident can open a savings bank account if they have 2 things: an Aadhaar card and PAN. Please note that both these things are mandatory if you want to open a savings bank account. Now let's talk about some key features of a savings bank account. There are some exceptions when the mandatory minimum balance criteria is not applicable. For example, if you have opened your savings account under the government's financial inclusion plan or the Pradhan Mantri Jan Dhan Yojana, there is no minimum balance requirement. Now, the second type, the current account. These accounts are basically used for daily business activities. In simpler terms, where there is a need to frequently transfer money from one account to another. These are mainly business accounts and mostly used by corporations and businessmen. If you're wondering about the benefit of a current account, it has a special overdraft facility. Under this, you can withdraw more money than what is there in your account. The third account type we talk about is the salary account. As the name suggests, these are the accounts for the purpose of salary transfer. Banks allow these accounts on the requests of corporations and entities that want to disburse salaries to employees. So the account where you get your monthly salary is called a salary account. Now let's talk about the fourth type, Demat accounts. This account helps investors hold shares and securities in the electronic form. That means it helps you keep a track of all your investments, be it mutual funds, shares, bonds, or exchange-traded funds, all at one place. Overall, it helps investors trade and invest in equity shares in the stock market and converts the share certificates from the physical form to the electronic form. There are 3 types of Demat account: regular Demat account, repatriable Demat account, non-repatriable Demat account. How to open a Demat account? Select depository participant according to your requirements. In India, stockbrokers, banks, and online investment platforms offer DP services. Visit the DP site and fill the Demat account opening form. Also assign nominee. Fill the information on Know Your Customer norms. Submit the scanned copies of all the documents required. Go through the verification process known as in-person verification or IPV. It can be done at the DO office or online. Sign an agreement which includes duties and rights of both DP and investor. After this, your request for opening account will be approved. Finally, you will get a unique beneficial owner identification number or BOID, which you can use to access the Demat account online. That's all we have for you today. We will be back tomorrow with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.